very good evening. You're watching The Money Show on ET Now with me, Mubina Kapasi. This is your one-stop shop and daily 1 hour long dose of everything to do with personal finances. Today, we have a very interesting topic that we have lined up. Making your child a multi-millionaire. And when I say multi-millionaire, I mean a crorepati. Yes, you may be wondering that if you are your average Joe who may be in your salary, how can you ensure that you leave behind a legacy worth crores of rupees for your children? Well, I have none other than Mr. PV Subramanyam of Subramani.com to spill the beans on that. And later on the show, we'll be talking about motor insurance, the new norms that have come in, why perhaps when you will buy your next car, you may not have to roll out much on insurance. And later on the show, buying second-hand cars. Interestingly, of course, car sales are back on track. But if you want to buy a car, wondering if you don't have that much cash, then maybe a second-hand car could be a good option for you, especially for those people who are a little worried about using public transport amidst this health crisis that has broken out. So let's first bring on board Mr. PV Subramanyam then to talk about the topic of how to leave behind a legacy of crores of rupees for your child. Mr. Subramanyam, thanks so much for joining us today on The Money Show. Everybody would want to leave behind something for their child, right? And yeah, when you throw the proposition of how about you leave behind hundreds or thousands of crores for their child, of course, there is going to be a significant amount of delight, but it could be accompanied by a significant amount of skepticism as well, especially for those who are your regular salaried earners who may be earning fixed income and who in turn as well may have not got a whole lot from their parents to think that, okay, maybe that will appreciate in value and I can pass it on, to my child. So firstly, is such a scenario possible where I would be able to leave behind or ensure that my child becomes a crorepati?
See, a crore is something very simple. Mubina, you have to understand that with inflation, like for example, when your father was your age, for him to say, can you leave 10 lakhs for your kid would have been like, oh my God, will I be able to leave 10 lakhs? And today you're not even talking about 10 lakhs because that is the CTC for any chartered accountant would start on the CTC more than that, right? So 10 lakhs has become quite insignificant. So similarly, yes, you can leave much more. All you have to do is make sure that when you start an SIP, the most important thing is to teach the child not to touch that SIP for very long periods of time. So even if somebody can start off with something like 3,000 rupees a month for a kid who's born today, like, maybe 1 year old or less than 5 years for sure, by the time the kid is 60, 65, that should touch a figure of something like 100 crores. Where is the question of leaving 1 crore? But again, Mubina, you're talking of 65 years of compounding. That is something which you have to accept that is the kind of money which the middle class doesn't think, which only the business class thinks while leaving for their children.
What if somebody says that, maybe, many a times people have this patience problem, right? And especially the younger generation. One of the proof is also in the pudding of the fact that we're seeing an increase in trading activity. So perhaps people are looking out for this instant gratification kind of attitude. So why do you think that to create this enormous amount of wealth, patience is key? If you could explain this concept of power of compounding.
Assume you start an SIP for the kid when the kid is just 1 year old and you keep on telling the kid, do not touch this money, right? Like somebody in your family planted a tree, you don't even know who, your grandfather's elder brother, younger brother planted it maybe 100 years ago. When you go to your village, you still eat a mango from that tree, right? You don't ask, ye kisne plant kiya? And if your neighbors come, you're happily, willing to pluck a couple of mangoes and give it to them because there is so much. So you have to create that abundance. So you have to teach the children, like, in a business family, when they set up a business, they expect the next generation to run it. Look at the Birlas. When they set up Hindalco, GD Birla didn't think that the plant will close down when he dies. Today, the 4th generation or 5th generation is running it. Exactly like that, you have to create a heirloom, start with a small amount and keep increasing the SIP by 10% a year or 15% a year, whatever you can. And you will be able to create these kind of heirlooms over long periods of time. But right, I said patience. So you create other pockets of money for your children I'll tell them, ye jhaad ko haath mat lagao, because this is a tree which is going to feed you and your next generation and the generation after that for a very long period of time. So don't cut the tree, just eat the fruits.
How important is also persistently watering this plant? Since if I could continue the metaphor that you started off in terms of watering a tree, and it's very apt, right? Many a times financial advisors do compare creating wealth as a process of sort of planting a tree, waiting patiently, and then enjoying its fruit. So how important is consistently watering this money plant as well, so that you're able to enjoy the fruits later, and also to be able to tell your child that, listen, even if, I mean, you ensure that even if I cannot sort of maybe sustain that yearly or monthly investment, you need to do that, because at the end of the day, of course, it's going to benefit the child and their child in turn. So how important is it to be consistent with your investments?
28 or 30 by the when he has a kid. I mean, I'm assuming on an average. So let us say he starts even a 30,000 rupee SIP. That may be a big amount for him. That's fine. But he is able to start and he's able to increase it by 5% or something every year. By the time he's 60, he'll obviously not be able to, after that, be able to contribute to that. Then his son takes up a job, right? By the time his son will be 30, so he would be in a job. So it's the time that the son starts continuing that. That is exactly what happens in the business, right? If the son wants to enter the business, he also becomes, he takes the same effort, like he becomes a doctor or he becomes a chartered accountant and continues the practice. Exactly like that. You continue this and you keep putting money into it. In a worst case scenario, some years you can't put, that's still okay, but don't cut the tree, to continue the same example. Now, even in the tree, what happens is first few years you have to water. After that, the tree knows how to find the water through its own roots, right? So 5-6 years you put water and the tree is up and it is fruit bearing. After that, you don't really even have to water it. Yes, you have to make sure that the tree is not cut, that if in case there is a storm or something, the tree will be affected. But other than that, as long as you can nurture the tree, if you can keep doing more SIPs, like 30,000 today, after 30 years is not going to be a big amount. So that kid, when he starts earning, he'll say, Dad, I can't do 30,000, I'll do 1 lakh or something like that. So then afterward, his own kid may be doing 10 lakh rupee SIP, because that is just the impact of inflation. That way, this corpus just remains as it is. And it keeps growing. And you take a growth plan and you don't touch it at all. That's all.
So even if, let's say, for a few years, maybe if cash is tight, doesn't matter, you can pause it, but make sure you don't redeem it. What Mr. Subramanyam said when it comes to make sure that your tree is not blown away by a storm. Maybe the idea is that make sure that your child does not get up and start, redeeming your money, redeeming that fund, for whatever reason. Mr. Subramanyam, a key aspect over here is also returns. And I guess maybe some of our viewers may find this very difficult to digest, because they'll tell us that, oh, I've been investing for the last 3 years and I have not seen anything. In fact, all of my NAVs are in the negative. I have lost out money in so many of my, especially my small cap and mid cap funds, which have had not such a great year, especially if they've started investing in the last 2-3 years. So how would you sort of convince these people, because these are the ones that have unfortunately seen only the bad times of investing?
No, Mobina, you should be celebrating, because the person who really wants to withdraw now is perhaps your grandfather. You're still going to be contributing for the next 20, 30, 40 years. Your father is still going to be contributing. Who needs a bull market? Only a person who is above 80 years of age or 85 years of age, who is in the withdrawal stage, right? And suppose your grandfather also doesn't need to withdraw, then it's again the money is going to his grandchildren or his great grandchildren. So only the cash that you need for your day-to-day living, you need it in cash. The other things can be in assets. It doesn't matter. Look, you buy a house, you shift in, then somebody tells you the value of the house has fallen. What do you say? You say, ठीक है ना, मुझे तो रहना है वहाँ पे. So similarly, this, if you want to withdraw this money in 2080 or 2090, why should you be worried about the NAV in 2020? You should be celebrating this fall. If you have chosen a good fund, you know that there will be reversion to the mean and the fund will do well. So absolutely, most important thing is to teach your children patience and say, इस fund को हाथ मत लगाओ. बाकी I have created other funds for you. You can use that for your foreign trip. Maybe you can use that for buying your house. You can do all that. But this one particular fund, leave it alone and just let us create a family heirloom for you. In case of an absolute dire emergency, you can dip into it. Otherwise, don't touch it.
Okay. One aspect that we have not touched yet is essentially topping it up. Like you mentioned, let's say if somebody starts with maybe 20,000, 30,000, 35,000, so on and so forth, and maybe they started when the child was maybe just born. So maybe the individual is 25, 30, 35 years old. But obviously the income is not going to stay stagnant. It's going to constantly increase, right? Maybe not in this COVID year, but next year, next year, so on and so forth. Incomes will increase. How important is it to top up your investments as well and ensure it keeps pace with your income?
Mubina, actually, if you see, you're just keeping pace with inflation. So this year, if you put 1,000 rupees, next year it's fairly obvious that you should put 1,050 at least, or 1,100. Assuming inflation is 5% every year, you have to increase it by 5% at least, right? You're just keeping in pace with inflation. You're not doing anything else. But yes, suddenly at the age of 48 or 50, suppose the income doesn't increase, then you hold it constant, and that's okay for some time. It is okay not to contribute for a few years. It is okay to contribute a little less for a few years, but don't interrupt the compounding by removing money from it. Don't remove the money. Till then, let it be fine. Let it just keep growing. उसको interrupt मत करो.
Okay, without any interruption, continue with these investments, and of course, touching this fund is going to be an absolute crime by you, by your child, your grandchild, so on and so forth. Now, Mr. Subramanyam, is it reasonable to expect the market to be able to give okay, maybe 15% year after year, maybe a little too much, but what would be a reasonable return to expect from the market? And I ask you this because when we say that, okay, I want 1,000 crore portfolio for my child, a lot would also depend on what the return that the market can give me. So would it even be fair for individuals to think that, I want the market to give 8% or 9%, or should they just not have any such expectation?
No, Mubina, it's something like this. Suppose you stay in South Bombay. Suppose you want to go to Pune. You take a Google map and you ask, and it says 4 hours or 3 hours. And after you leave somewhere, when you reach somewhere near Vashi, it tells you, please take a different route because there is an accident here at Panvel. So you may have to take a different route. So, and then you might take 5 hours instead of taking 4 hours. What has happened is during the course of the journey, things will change. And even Google didn't know that an accident is going to happen. When you were at home, it didn't know about the accident. After you reach Chembur or Vashi, it knew about this accident. It is rerouting you. So today for you and me to sit कि अगला 60 साल क्या interest rate मिलेगा it's not going to be possible. We all know that. But in Excel, you can't do that. So in Excel, you have to put a number. So you put a number of say 15 or 12. And then going forward, you see how it is. Suppose you're getting only 9%, which is fair enough because inflation is only 3-4%. Then afterwards, you have to rejig the number and say, okay, I have to put more money if I have to reach that corpus, or I will reach it at a later stage. That is all you can do. Trying to guess over next 30-40 years what you will get, very difficult to do. You can't even give a range. I can't even tell you will get anywhere between 6 and 15%. I don't know the range. But yes, the range will be about 20-30% more than what you will get in your, say, PPF today. So today you're getting about 7% in PPF. So you should be able to get 8-9%. Will you get 15%? No, unless inflation goes up. Then so real return of 2-3% is what your fund manager should be able to target.
Okay, so some very important lesson. I just want to summarize it up for our viewers. And I think Mr. Subramanyam started off with a very important point. For your child, 1 crore is definitely not going to be enough. Just as your father, if he had to save up for you, 10 lakh rupees is definitely not going to cut it, because today it's maybe a CA starting salary, an engineer's starting salary, or maybe even more than that. So inflation is something that's extremely crucial to understand. A simple way to ensure that you leave behind a legacy that's worth not just a few crores but hundreds or thousands of crores is starting early and investing consistently for the next 50 to 60 years. Consider it as a crime to touch this money, this fund that you have set aside, because it's purely and purely for your child and maybe their child in turn, and that's the only way long-term wealth and this corpus of wealth can be created. Disciplined investing of 20-30,000 rupees per month, that'll come to around 3 to 4 lakh rupees per annum. try to step it up, because you also have to take in mind inflation. Every year you have, I mean, currently the last inflation reading read about 6%. So you're looking at least 6% every year inflation. So try and step up your investments as well, and make sure that your child does not touch this corpus either until he or she perhaps attains in turn the age of 50, 60 or 70. And that's how you as well can sort of ensure that your child too becomes not just a millionaire, but a multi-millionaire. Okay, well, let's do one thing, and I'm sure this is something that all of you all do aspire to be able to sort of leave behind a legacy for your child. So let's take on board some questions and queries as well. If you have any, you can email us on themoneyshow@etnow.tv. Right now, we'll get straight to that in our Ask the Money Show segment. Let's take on board a very first question for now that we've received via email. First up, we have Narendra Upadhyay, who writes into us saying, he has a couple of mutual fund investments since 2017 with 11 lakh rupees in total that he's already put in. He's putting this money for his daughter. So he started 3 years ago. His daughter is 6 years old. But he notices that most of the funds are in the red. So he now wants to know if he should shift his funds. I guess, Mrs. Subramanyam, this is something that we did address, right? That if people who started investing 3 years ago, they definitely are not looking at the best market right now, especially if they'll open their CAM statement, it's just probably going to be red all over. Nevertheless, let's read out his portfolio. 6 funds: HDFC Top 100, Sundaram Mid Cap, ABSL Tax, Franklin India Primer, HDFC Equity and Kotak Blue Chip. 6 funds, total corpus so far in the last 3 years that he's invested in is 11 lakh rupees. Of course, it's an SIP of roughly you could say around 20,000 rupees is what he's investing on a per month basis, maybe a little more than that. So, Mr. Subramanyam, what would you advise him to do?
Yeah, first of all, I think he's got too many funds. So he does not need so many funds. If you see, he's got HDFC Top 100, he's got Kotak Blue Chip, both of them, and HDFC Equity. All three have more or less similar portfolios. So he need not have 3 of them. So he can just stick to HDFC Equity and stop the other 2. And similarly, he can exit, say, Sundaram Mid Cap. I think the Aditya Birla ABSL tax relief must be for 80C, so let him continue that. And Franklin India Prima, let him continue. So out of 6, he can exit 2 or 3, and he continues the other 3, and that's enough. He doesn't need to do more. The first question he should ask himself is, what is his daughter's age? His daughter is not suddenly aged. She's just 6. So assuming he needs it for her education, he needs it after 12, 13 years. Or if he wants it for post-graduation, he needs it after 15 years. So the time to look at it is then. Mubina, look at it this way. You're an employee. You have had a very bad sale 1 month. In that month, if the appraisal is done for all the sales people, it's going to be a disaster, right? So this is a bad time to be looking at your portfolio. Corona has definitely eroded everybody's portfolio. So it's not a good time to look at it. Best is to keep your eyes shut, keep doing the SIP, and look at it once the market goes up.
All right. Okay. I think we've just. I think there seems to be some sort of audio issue with Mr. PV Subramanyam. We'll just get that sorted. But yeah. And like Mr. Subramanyam said, right now is not the time to essentially, look at your portfolio, because obviously things are a little, a bit weakish right now. The CAM statement will obviously reflect red, because we are in the midst of the coronavirus. Markets have crashed quite a bit, so it's obviously taken down NAVs as well. So yeah, it's important to essentially understand that bit. Okay, we managed to get Mr. PV Subramanyam back on board. Mr. Subramanyam, I just have a follow-up question on that. You did flag off the fact that, there are a couple of funds that that do have common stocks. There's a repeat, essentially, so it makes no sense to keep all of these funds. Now, just to connect it back with our conversation that we were having about leaving or investing in money for your children, which will be maybe 50 to 60 years later, you would be, what would be the mix of funds you would be advising? Because we have large caps, we have, Nifty 50 ETFs, and then we have small caps, balance advantage, mid caps, so on and so forth. And of course, we're looking for long-term investing. So maybe you don't need debt or anything in your portfolio. So what would you advise as a good mix of funds?
I would invest about something like 60% in large caps, about 30% in mid caps, and about 10% in small cap. And I wouldn't worry about rebalancing over very long periods of time.
Okay, all right. So I hope everyone has taken note of that ratio. And yes, don't worry about rebalancing for extremely long time. Remember, your time horizon is almost 60 to 70 years. Okay, let's take on board our next query. It's coming in from Santu. He writes, how do I retire rich? I'm 30 years old, married. How do I keep my retirement plan precise? Need money for kids' education, marriage, and also a home loan down payment. He wants to be a do-it-yourself investor, and he says he wants to add new funds every year. I think that's what he means. And he's asking you, of course, for your advice. So he clearly does have, he has kids, and that means he has 2 kids, I guess, Mr. Subramanyam. What would you advise? I mean, who doesn't want to retire rich, right? Mr. Subramanyam, I think you've written a book on it.
See, the question is you got to prioritize, right? So it's very important that you know that your children can borrow for some of their requirements, right? Your daughter can you can give 20 lakhs to your daughter and say आगे का आप borrow कर लो and you repay the loan. Or for your son's education, you can give him 20 lakhs and say, here is my contribution of 20 lakhs, because you have to understand your priority has got to be your retirement. So once you have that as your priority, you should not touch that. You cannot say, I will pay for the retirement, I'll pay for my children's indulgences, I'll do an expensive wedding and all that, and then still have money for retirement. That's not going to happen. There are 2 problems, Mubina. One, you might retire earlier than you wish to. You may want to retire at 75, but everybody doesn't get a chance to do that. So you may retire at 52, 53, and you may live till 100. So you may need money for another 40, 45 years. That's not going to be easy. So you have to prioritize. What happens is the urgent takes the place of the important. Your retirement is important. Your children's education is urgent, because that will happen when you're 47, 48, and your children's wedding could happen when you're 54, 55. So obviously that will look like it is more important. That's not true. They're more urgent. They are not more important. You have got to keep your retirement corpus separate. For people who have this issue, they should take a pension plan and make sure that pension plan is locked in so that they cannot touch it. I would never recommend a pension plan to anybody who's got enough discipline to say, okay, need to put 5 crores away for my retirement, and only after that I'll prioritize my children's expense. Let children borrow. You can help them, but does not mean you have to exhaust all your money in educating them and getting them married. Makes no sense. And marriage expenses, people should be now thanking the coronavirus. All marriages are only 50 people. So now you can't spend that few crores on a wedding. Even if you spend 5,000 rupees per plate, you could spend only 2.5 lakhs. So
Well, yeah, that way perhaps it's come in, as an unfortunate but lucky coincidence, I guess. Maybe a wake-up call that, listen, people don't need to spend so much on weddings. But yeah, let's move on and take on board our next question very quickly. Sarvajit Singh, he says, I'm 40 years old. I want to continue SIPs of 1 lakh rupees for the next 15 years. Ready to increase it by 5% year on year. Kids' education, retirement, key goals. He also says that if I want to increase SIPs in the future, which he does plan to by 5% year on year, he wants to know if he should rejig his funds. Well, if that gentleman had 6 funds, Mr. Subramanyam, Sarvajit actually has, well, almost 10 funds: SBI Magnum, Kotak Standard Multicap, PPFAS, L&T Emerging, Nippon SBI and HDFC Small Cap, Murray Asset India, Murray Asset Emerging, and Canada Robeco Emerging. So what would you advise, Mr. Subramanyam?
see, largely people have to go to that old formula which I said about 50-60% in large cap. I can't see too much of large cap here. He's got all small cap, right? He's got all small cap, emerging equity, emerging blue chip, small. Yeah, he's got PPFA's long-term equity, which is multi-cap, but he's got no large cap, which is very funny, because when you're putting 1 lakh rupees a month and you don't have any large cap, that's quite a little odd, because you're only 10 years away from your first goal and 18 years away from your second goal. So obviously you should exit some of the emerging market. He's got the L&T emerging equity, he's got Nippon small, he's got SBI small, HDFC small. Out of the 4, he should exit 2 of them. Maybe he should exit SBI small cap, he should exit L&T emerging equity, he should increase in PPFAS, he should increase maybe in Nippon small cap. HDFC small cap, let him continue just 2 small caps. He should exit Mirai and he should continue Can Rebecca emerging equities. And then if he still wants to increase after this next year, when he wants to increase, he should add one large cap index fund, and that's it. He should keep on increasing in that index fund up. So which means he'll go from 10 funds to something like 5 or 6 funds, and that's it. Below that, he still has some. He's got some ELSs also. He's got 6 ELSs also. So I don't see why he should have another 6 more funds. So he's large. He should look at a large cap ELSs and put 1,50,000 per annum in that and take his ATC benefit.
Yeah, many a times people consider ELSs to be serving a different purpose, and that's for tax saving. But at the end of the day, they as well are mutual funds, you know, investing in different shares. Okay, very quickly, we've just received another email query from Dheeraj. He says that with such a big amount and such a long time frame, that's yes, go ahead, Mr. Subramanyam, you were making a point.
Saying ELSs again is not a class, because there can be a large cap ELSs, small cap ELSs, multi cap ELSs. Unfortunately, we tend to call all ELSs as one. That is not true. You have to see what it is. ELSs is a package. आपको package के अंदर देखना है कि क्या है.
Okay. Okay, very quickly, let's take on board our query that has come in on the topic that we were discussing, and that's, you know, creating 1,000 crore corpus. Now, Dheeraj asked that with such a big amount and such a long time, he wants to know your thoughts, Mr. Subramanyam, on setting up a trust fund, perhaps in a jurisdiction outside of India. Any thoughts that you would be having on that, Mr. Subramanyam?
Not really. This is not such a big amount. Please understand, today it is only 30,000 a month. For you, cost of setting up a trust, getting it audited, etc., will also cost you about 50,000-60,000 a year. So right now, no. Once the corpus becomes very big and then you're worried, then you can create all this. But right now, I see no reason to set up a separate trust and all. Trust, yes, makes sense only if you have somebody who is not capable of handling, somebody who is retarded, or somebody who's unable to take it, then maybe a trust. But for a normal person, no. With the capacity to contract, absolutely no person. Yes, somebody is paraplegic, somebody can't sign and those things, then a trust. Otherwise, no.
So maybe it'll be your child's headache then to create a trust when you'll be able to leave behind such a big amount. Okay, Mr. Subramanyam, thank you so much for joining us today on the Money Show with such an interesting topic, folks. This will be available on YouTube, so subscribe to ET Now's YouTube channel. For now, we'll take a very short break.